In every cycle, there seems to exist a strange moment, a tipping point of collective amnesia, when the question, can home prices actually fall, fades away and is replaced, too late, by the whisper, why didn't we see that coming? Let's rewind. In 2006, lenders with confident smiles swore that everything was perfectly safe. 14 years later, in 2020, a new generation of investors chanted the mantra, this market only goes one way, up. And now, in 2024 and 2025, millions of Americans have lulled themselves to sleep with a modern fairy tale that a chronic housing shortage has created an eternal shield, making it impossible for prices to ever stop rising. But history, the most brutal and honest storyteller of all, doesn't work that way. I have walked through more housing booms and busts than most people have had birthed, and through all those tides, I can tell you one thing with absolute certainty. The real danger never comes from the visible fear, from the things everyone is talking about. It creeps in from the very things we take for granted, the things we ignore. And right now, the thing being ignored is smoldering like a fire beneath the ground in 5 specific US states. I say this not because I'm trying to predict a crisis, I don't like that word, because the numbers don't lie, because insurance risk is swelling, because migration patterns are reversing, and because a hard reality about income is creating an invisible pressure that most households are simply not prepared to face. If you carry the dream of buying a home in 2026, or if you are betting your family's financial foundation on the belief that nothing can go wrong, then perhaps this is what you need to hear. When people look at the housing market, they are often captivated by the flashy headlines instead of the foundational elements. Record low supply, prices hitting new highs, homes still selling above asking. That is the truth, but it is an incomplete truth. Markets rarely collapse from the glittering peak. They rot from the roots up. And what I'm witnessing right now is that the foundation in several states is beginning to show deep, structural cracks. No, not across the entire United States, not even in the majority of it. But in 5 specific places, the conditions there are converging in a way that is eerily familiar, reminding me of every period that preceded a major correction. People are overextended. Insurance and tax costs are rising faster than incomes. Investors with bottomless pockets are dominating neighborhoods, pushing families to the sidelines. Builders, drunk on victory, are creating supply that outpaces real demand. And beneath the surface, the job market is quietly weakening, and the once booming migration trends are silently reversing. But for now, it seems no one has noticed. A market doesn't crash just because prices are high. You get knocked out when the total cost to carry that home exceeds your ability to pay for it. And by 2026, that deadly formula is becoming incredibly fragile in Florida, Texas, California, Arizona, and Nevada. What makes it even more dangerous is that it's for a different reason in each place. This isn't a single domino. It's 5 different dominoes, all leaning in the same direction. And now, let's begin with the question everyone should be asking, but rarely does. Why 2026? Why not now or in 2030? The truth is, markets don't react when a problem begins. They react when the problem becomes unbearable, when the pain becomes acute. And 2026 is the point of convergence, the moment when many smoldering fuses will ignite at once. Picture this. Millions of homeowners bought or refinanced their homes at dreamlike interest rates of 2 to 3% in 2020 and 2021. These people are, financially speaking, frozen in place. They cannot move without tripling their mortgage costs. But starting around late 2025 into 2026, a new wave of owners will hit the market. These are the people who bought with rates between 5.5 and 7.5%, those holding adjustable rate loans, and those who had to overspend during the frantic bidding wars of 2021 to 2024. When these groups try to refinance, many of them will not get the numbers they expect. Some won't qualify at all. And you have to understand, refinancing is the pressure release valve for the entire American housing system. It's the escape hatch, the glimmer of hope for those buckling under financial strain. If that valve got stuck in 2007 and caused a catastrophe, then by 2026, it's going to be clamped down even tighter. For the last half-century, insurance was the silent hero of the American housing market. Nobody talked about it because it was cheap, predictable, and boring. But the reality is, boring things don't stay boring forever. In 2024 and 2025, something unprecedented happened. Insurance companies began quietly pulling out of entire regions. Premiums didn't just rise, they exploded, doubled, tripled, and in parts of Florida and Texas, they quadrupled. By 2026, this will no longer be a coastal anomaly. It will be a national issue. Imagine this. You can afford your monthly mortgage, you can pay your property taxes, but if one day your insurance bill suddenly jumps by $3,000 overnight, you can no longer afford your home, and lenders will never accept an uninsured mortgage. There is no way out, no room for negotiation, no discount code. Insurance is a binary product. Either you have it or you lose your house. In states like Florida, Texas, California, Arizona, and Nevada, 2026 is the fateful intersection where insurance affordability collides head-on with real-world wages. Now, here's a little secret few people will tell you. The housing market weakens when investors pull back, not when homebuyers get hesitant. Over the last 5 years, investors from Wall Street giants to local Airbnb operators have devoured a massive number of homes in many states. But high interest rates don't just hurt families. They hurt investors, too. When rental yields start to drop, when vacancy rates creep up, when insurance costs eat away half the profit, what do investors do? They sell, and when they sell, they don't negotiate with emotion. They don't fall in love with the marble countertop. They don't care which grandmother lived in the dining room. They cut the price, fast. The first wave of investor divestment began in mid-2024. The second wave will arrive in 2025, and the third wave will accelerate in 2026, especially in the 5 states I'm about to break down. When investors sell, the market stops rising. When families stop buying, prices start to fall. And when both happen at the same time, you get the picture. During the pandemic, a great migration took place. People flocked to Florida, Texas, Arizona, and Nevada. But by 2024 and 2025, the story had completely changed. The cost advantage vanished. The insurance advantage is gone. Even the tax incentives have diminished. And for the first time in a decade, the data showed something subtle but critically important. The rate of in-migration slowed down. The wave of out-migration grew. Prices continued to climb, but real demand did not. That is how a market quietly reaches its peak. And by 2026, migration will become a headwind pulling the market down, not a tailwind pushing it up. I've said this 1,000 times. Housing is local. And the truth is, on the whole, the U.S. economy is doing quite well. Companies are performing, productivity is growing, unemployment is low. But a local economy doesn't necessarily follow the national headline. It runs on its own set of rules. Its industrial mix, its insurance risk, its water supply, its tourism, its tech layoffs, its property taxes, its population shifts, and the profitability of its landlords. By 2026, the national story and the state-level story will begin to move in opposite directions. Some states have stabilized, some are overheated, and a few, including the 5 we've chosen, are facing a very real structural imbalance. And when structural problems meet sky-high prices, that's when a market gets volatile. So, when people ask me, Warren, do you think U.S. home prices will fall? I always have the same answer. No. Not the entire United States, but in certain pockets of America, absolutely. Because the market isn't a single, concrete block. It's a mosaic, made of thousands of large and small tiles. And in 2026, that mosaic has 5 tiles that are glowing bright red. Now that we understand the timing, let's turn to the first tile, the state where the simple math is starting to break. Florida. This is perhaps one of the most misunderstood housing markets in the entire country. People talk breathlessly about the sunshine, the retirement dreams, the endless migration, and a demand that seems to explode forever. All of that is true, but none of it can protect you from the single biggest financial risk that Florida homeowners are now facing. In Florida, insurance is no longer an annual expense. It has become an existential threat. In most other states, insurance costs are predictable, almost a fixed number. But in Florida, it acts like a second mortgage, an invisible monster that can double in size without warning. And this is what most buyers don't realize until it's too late. First, premiums in Florida aren't just rising. They are compounding exponentially. Listen closely. The $2,400 premium from yesterday became $4,800. Then that $4,800 became $7,200. And that $7,200 has become $11,000 for the very same house. Because the risk Florida now faces isn't just hurricanes. It's a perfect storm of multiple factors. A scarcity of reinsurance companies, skyrocketing litigation costs, construction inflation, an aging housing stock, the increasing concentration of storms, the expansion of flood zones, and most terrifyingly, the mass withdrawal of insurance carriers. When insurers leave a state, they don't declare a panic. They simply raise prices until their customers are forced to leave. And so, Florida is experiencing something rare in American history. Affordability is collapsing even while prices are still high. Not because of mortgages, but because the cost to operate a home is exceeding the ability to pay for it. Second risk, Florida's prices are dangerously dependent on perfect migration. The real estate boom here isn't driven by locals buying homes. The primary engine comes from the outside. Retirees, remote workers, wealthy transplants from New York, cash buyers, and investors seeking short-term rentals. If just one of those capital funnels slows down, the entire price structure weakens. And in 2024 and 2026, that is starting to happen. The volume of cash deals is falling. The insurance shocks are scaring away out-of-state buyers. Short-term rental profits are shrinking, and condo and HOA fees are skyrocketing due to new building regulations. Florida needs perfect demand to maintain stability, and markets that require perfection ever stay perfect forever. The third risk, a silent correction, is already happening under our feet. Prices aren't falling statewide, but they are bleeding out in certain segments. Inland new construction, older coastal condos, and areas saturated with short-term rentals. Sellers are offering concessions. Builders are rolling out 5% price cuts, and condo reappraisals are jumping by 20 to 50%. These are not rumors. These are the early signs of a structural distortion. Florida won't completely collapse, but the next buyer, the one who steps into the market without a margin of safety, could easily overpay by 10 to 20% without even knowing it. Because risk is the thing you cannot see until it shows up on your bill. The real problem isn't the storm. It's the unpredictable volatility of the carrying cost. If your insurance premium doubles, you can't refinance your way out of it. Florida, in the long term, remains a fantastic market. But in 2026, it will be the most financially unpredictable state in the country. Now, let's leave the blazing sun of Florida for a stage of extremes. New York, a place of staggering wealth, of boundless opportunity, but also of absurdly expensive prices and sky-high costs. But markets don't break because of extremes. They fracture from within when the value equation no longer makes sense. And in 2025 and 2026, the New York housing market is caught in that very trap. Prices are behaving as if we're in the golden era of 2010 to 2015, but the fundamentals are telling a completely different story, a 2026 story. Let me show you the three factors that are quietly destabilizing this glamorous state. The first factor, the silent out-migration of its residents, is real and it is persistent. This isn't a political talking point. This is data. New York City has been losing residents for years, especially middle-class households, retirees, remote workers, families seeking more affordable living, and young professionals looking to escape the tax burden. The issue here isn't that the rich are leaving. It's that the pool of homebuyers, the very foundation of any market, is shrinking. When the river of middle-income buyers begins to run dry, the entire system becomes top-heavy, and a top-heavy system doesn't collapse instantly. It tilts quietly until suddenly the cost to operate it far exceeds the value it provides. And that is the second risk. In New York, the real burden isn't the mortgage. It's everything that comes with it. High property taxes, school taxes, city taxes, HOA fees, maintenance fees, slowly rising insurance premiums, and inflation on heating and utility costs. Home with a monthly carrying cost of $3,500 in the Midwest could easily cost you $6,800 in New York. Not because it's better, but because the system is brutally more expensive. When the cost to maintain an asset outstrips its perceived value, the market becomes incredibly vulnerable. Not immediately, but inevitably. Third, and perhaps most important, confidence is silently eroding. In real estate, confidence is everything. New York's pride was built on relentless job growth and irresistible urban magnetism, sky-high salaries, and global cultural prestige. But the remote work revolution has completely changed the game. You no longer need to live in New York to earn a New York-level income. And once a city can no longer require its residents to live there, the price of admission suddenly becomes optional, and expensive options are abandoned faster than anyone thinks. You can see it in the stagnating condo prices, in the lengthening time a home sits on the market. Concessions are coming back. Landlords are offering months of free rent to keep tenants. These are the first cracks on the glamorous surface, signs that the market is losing its negotiating power. Price is what you pay. Value is what you get. But sometimes, you just don't get enough. New York City isn't collapsing, but its value is being overpriced relative to its tax burden, its carrying costs, its housing quality, and its long-term migration trends. That mismatch is the real risk. You know, when people talk about Texas, they often use words full of energy. Boom, rapid growth, unstoppable opportunity. And they're not wrong. The state has incredible population growth, major corporate relocations, dizzying housing development, and relentless job expansion. All of those factors usually signal a healthy long-term market. But whenever you see growth that looks too perfect, too consistent, or too easy, you should stop and take a closer look. Because unchecked growth doesn't act like a sturdy ladder, one step at a time. It acts like a slingshot. It rockets forward with dizzying speed, and when it comes under enough pressure, it snaps back, faster than anyone expects. The Texas of 2026 is not a bubble in the classic sense. This is a problem of velocity. When the speed of growth outpaces the fundamentals, momentum is what matters, not value. And the moment that momentum slows down, people will suddenly realize that what they bought was speed, not stability. I'm going to show you the 3 factors that are making Texas one of the most vulnerable states for home buyers in 2025 and 2026. I want to start with something that most homebuyers overlook: the creeping costs. You can negotiate a mortgage. You can lock in a purchase price. You can even predict your property taxes within an acceptable margin of error. But insurance is a complete wild card. Over the last few years, Texas has quietly become one of the most expensive home insurance markets in the United States. And unlike Florida or Louisiana, where everyone can see the hurricanes forming on the news, the risk in Texas is far more diverse and complex. That's the part most buyers miss. In Texas, you aren't just buying insurance against a single threat. You are buying insurance for 5 different disaster scenarios: hail, wind, historic freezes, floods, and wildfires, plus the relentless expansion in the hill country. In any other place, just 1 or 2 of those risks would be a major problem. But Texas has all of them, all at once. Insurance companies don't care about politics or a good growth story. They care about one thing: actuarial math. And the math is showing that risk in Texas is accelerating faster than companies can smoothly adjust their premiums. What's the result? You don't see gentle growth curves. You see sudden, sharp spikes. An annual premium of $2,200 jumps to $3,400. Then that $3,400 becomes $4,600. And then suddenly, that $4,600 skyrockets to $6,000 just because a major reinsurance company readjusted its risk model. This isn't just inflation. This is a direct pressure point on affordability. And when affordability gets squeezed, prices don't fall slowly. They fall in sharp, episodic drops. Second factor: builders in Texas are building as if they're in the middle of a gold rush. However, the builders aren't the villains in this story. They are simply responding to demand signals. If people are lining up to buy homes, a contractor will be there to supply them. That's how a free market works. But in this cycle, there's a fatal flaw. Demand skyrocketed because Texas was cheaper than California. But supply is now rising faster than demand. So what happens when supply outpaces the number of people who can actually afford those homes? You see it happen in phases. Phase 1, incentives. Builders start offering perks like rate buy-downs, free appliances, help with closing costs, and cosmetic upgrades. Phase 2, price compression. Prices stop rising, then go flat. At that point, the profit margin on a new home sale shrinks dramatically. And Phase 3, existing homes lose their competitive edge. If a developer is offering a brand new home with a promotional interest rate of just 5% or 5.5%, what does a nearby homeowner, trying to resell their older home at the market rate of 7%, have to do? They are forced to cut their price to compete. That's the part buyers underestimate. The new construction, with its attractive deals, has inadvertently set a price ceiling for the entire area. And the existing, older homes will be the ones to take the damp. In Texas, the gap between new build incentives and existing seller desperation is widening fast. This is creating a structural pressure on the resale market for the next 24 months. This doesn't mean Texas will collapse. It just means the next buyer will lose their negotiating power if they act too soon. Imagine trying to catch a falling knife, except the knife is falling in slow motion, and everyone thinks they can catch it safely. People always talk about the low taxes in Texas, and they're right. Income taxes are low, but property taxes are like a second mortgage that never ends. And unlike a mortgage, they are never paid off. They never have an end date. And they never forgive anyone. Property taxes in Texas have become so high that, in many counties, they are effectively the equivalent of paying an extra 1.5% to 2.5% on your mortgage rate every single year. That makes Texas uniquely sensitive to any shock: a spike in insurance premiums, a period of price stagnation, a change in income, or a small fluctuation in interest rates. Because the total cost to own a home here is much higher than it appears on the surface. You don't invest in a home based on its list price. You invest based on its true cost of capital. And the cost of living in Texas is slowly approaching a dangerous threshold, a threshold where young families, the very people who are the pillar of long-term stability, are reconsidering if they can afford to stay. If the foundation of the market weakens, the entire price structure becomes unstable. Yes, Texas has a solid long-term foundation. It has growth, business, land, energy, and diverse industries. But fundamentals don't prevent cycles. They only determine the speed of the recovery. Right now, Texas has the characteristics of what I call a magnet state. It attracts people very quickly. But that also makes it more sensitive to friction. The moment the velocity of migration slows down, the market will immediately stall. The problem for 2025 to 2026 is that the magnet is still strong, but the friction is growing faster: insurance, property taxes, overbuilding, affordability, and price sensitivity. These are slow-moving pressures that eventually become fast-moving events. And that's when prices have to adjust. Not because Texas is weak, but because physics always wins against blind enthusiasm. Never confuse activity with value. Texas is buzzing with life. Trains, trucks, new subdivisions, corporate relocations, and non-stop construction. But activity does not equal safety. Activity is not a moat that protects you from risk. Activity is not a margin of safety that allows you to make a mistake. You need to buy value, not motion. And the Texas of 2026 will be full of motion. That, in itself, is what makes it vulnerable. California. This is a fascinating market to study. This is a place where the laws of economics don't seem to break. Instead, they can be bent further than almost anywhere else in the United States. In most states, buying a home is a major investment. In California, a home isn't just a home. It's an entire financial ecosystem. It's a form of tax avoidance, a political battleground, a status symbol, a retirement plan, a generational inheritance, and in many cases, the single largest investment a family will ever make. And that is precisely what makes California so incredibly vulnerable heading into 2026. Not because the state is collapsing, not because people are fleeing a panic, and certainly not because its economy is weak. In fact, California's GDP rivals that of major nations. The danger lies in something more subtle, more psychological, and more structural. The California housing market is built on something I call the net worth arbitrage trap. Existing homeowners are sitting on a mountain of equity, but the next generation of homebuyers cannot afford the very prices that equity has created. The gap between the haves and the want-to-has is widening every single year. And when that gap becomes too large, markets don't correct slowly. They reset quickly. Let me explain the three factors that are making California one of the highest risk markets for buyers in 2025 to 2026. The first problem in California isn't demand, it's mobility. Most homeowners in the state are locked into incredibly low mortgage rates, between 2 and 3.5%. They have massive, paperish gains, and their property taxes are frozen under Proposition 13. This creates what economists call the lock-in effect. But in California, it's a step beyond that. It's a lifestyle lock-in, a tax lock-in, and an equity lock-in, all stacked on top of each other. Ask yourself, why would a family accept their property tax bill jumping from $4,200 to $15,000 just by moving a few blocks away? Why would they give up a 2.5% mortgage to buy an even smaller house at a 7% rate? The simple answer is, they won't. And because of that, housing inventory remains frozen. And when the inventory is frozen, what do you think happens? Prices detach from fundamental. Not because demand is so strong, but because supply is being artificially choked. Imagine it like a pressure cooker, but with a lid that has been clamped on too tightly. It seems to work just fine, until the pressure inside exceeds what the mechanism can handle. Second risk, California doesn't need prices to fall to become risky. The risk emerges when the total cost of ownership soars far beyond what an average household can afford. Right now, in major markets like Los Angeles, the Bay Area, Orange County, and San Diego, the cost to buy a median-priced home requires an income that is double or even triple the median household income. This doesn't create a bubble. It creates exclusion. And this exclusion doesn't show up on price charts. It shows up in the decline of first-time homebuyers, in the formation of multi-generational households, in the long-distance out-migration from the state, in rising vacancy rates in certain condo segments, and in investor saturation followed by retreat. When affordability erodes this much, price movements become binary. Either the state somehow creates a brand new wave of demand, or prices must eventually adjust to meet the existing level of demand. In the past, California has always been able to create that new demand through international capital flows, through tech booms, through abundant venture capital, and through the IPO cycles of giant corporations. But those are cyclical sources of demand, not structural ones. And right now, the IPO market is quiet. The commercial real estate market is in deep trouble, and startups are no longer minting millionaires at the pace they did in 2015 or 2021. When that high-velocity wealth machine slows down, the housing market loses its shock absorber. And the final factor, this is the part almost no one talks about. California homeowners are sitting on trillions of dollars. Yes, trillions with a T of home equity. For years, that massive pool of capital acted as a stabilizing force. It dampened the motivation to sell at any cost. It prevented panic. It created a psychological certainty that real estate always wins. But equity only stabilizes prices when it stays locked inside the system. The moment that equity starts to become mobile, even a little bit, it creates waves. Here's why. When sellers with huge amounts of equity start to list their properties, they are more concerned with cashing out quickly than with maximizing their sale price. They don't need a sky-high price. They need liquidity. These are the retirees who are leaving, the tech employees who are relocating, the landlords forced to sell by new regulations, the investors facing negative cash flow, and the families who need more space and are moving inland. Just a small increase in the number of listings can create a major price correction when the buyers on the other side are financially stretched to their absolute limit. This isn't speculation. This is math. When affordability is broken and inventory begins to rise, prices don't fall by 35% in a crisis. They adjust by 10 to 20% at the local level and 5 to 12% at the state level. Not because sellers are panicking, but because buyers have hit their financial ceiling and simply cannot pay a penny more. The California market is like a world-class athlete. Brilliant, competitive, powerful, but increasingly dependent on ideal conditions to maintain its performance. Stable tech income, high IPO volume, low mortgage rates, confidence from international capital, steady job growth, predictable regulations, and contained climate risk. If just 2 or 3 of those things go wrong at the same time, the machine starts to misfire. And in 2024 to 2026, that machine has started to sputter. Tech layoffs have increased. The IPO market remains far below its historic peaks. Insurance availability is becoming more limited. Wildfire risk maps are expanding. The lock-in effect has reached a point of saturation, and affordability is at its lowest point in generations. This isn't a crisis. This is a recalibration, waiting for a trigger. Price is what you pay, value is what you get. But it's the premium that traps you. California has immense long-term investment value. The innovation, the weather, the culture, the industry, the capital formation. But it also has a very high premium for that value. The regulatory factors, the taxes, the insurance, the climate, and the scarcity. A premium isn't bad on its own. A premium only becomes dangerous when it exceeds the underlying value it represents. And California has reached that point. This doesn't mean prices will collapse, but it does mean the next buyer has very, very little margin of safety. The thing I always stress in every investment is this. If you buy a home in California in 2026 without a margin of safety, you're not buying real estate. You're buying a story. And stories can't protect you in a down cycle. Colorado is not like Florida. It's not like Texas. And it's not like California. The risk in Colorado is quieter, cleaner, and harder to spot. This is a state people move to for lifestyle, not for speculation. They want the mountains, the outdoor recreation, the clean air, the safety, and a high quality of life. Those are powerful drivers. In fact, their pull is so strong that people often ignore financial signals when they fall in love with a place. But markets don't care about scenery. They care about structure. And structurally, Colorado has entered a brand new phase, one that homebuyers in 2025 and 2026 need to understand very clearly. Colorado is not a bubble, but it is in the early stages of a cycle of fragility. It's a point where small pressures can ripple into much larger changes. I'm going to explain the 3 factors that are creating that fragility. Colorado's climate story once was quite simple. Mild weather, snowy winters, and crisp, cold days. But now, that picture looks like a messy cocktail of overlapping risks. Wildfire zones are expanding into the suburbs. The number of smoke-damaged games is rising. Hailstorms are causing billions of dollars in damage. And hanging over everything are the concerns about water scarcity in the West. Insurance companies are not sentimental. When their risk models change, premiums change with them, quickly and brutally. Colorado is now one of the most expensive states for hail damage insurance. Entire neighborhoods near the foothills have seen their premiums jump by 40 to 60% in just 24 months. This isn't temporary. This is a permanent recalibration. And when insurance premiums rise faster than home values, you realize something that most homebuyers miss: the negative compounding effect on affordability. For every extra $500 in an annual insurance premium, it's the equivalent of adding about 0.1% to 0.15% to a mortgage rate from the buyer's perspective. All of those small numbers add up, and they slowly make the market thinner and thinner, until suddenly, the market isn't slow anymore. Second factor, Colorado used to be one of the fastest growing states in the country. But as home prices rose absurdly faster than incomes, something subtle happened. Migration slowed down. Internal moves within the state decreased. First-time homebuyers were priced out, and families started looking for their dreams in Utah, Idaho, or the Midwest. This doesn't show up as a spectacular crash. It shows up as a slow bleed of demand, especially at the entry level of the market, the very tier that supports the entire value chain. When demand for lower-priced homes weakens, the mid-tier market stagnates. New construction slows down. The price floor for the whole market becomes unstable. Sellers lose their leverage, and the bidding wars disappear. Colorado's problem isn't that people don't want to live there. It's that fewer and fewer people can afford to live there. And affordability is the engine that runs the housing market. Even a beautiful state can suffer from severe price pressure. Lifestyle cannot replace math. And the third factor, people often assume that scarcity will protect prices. Sometimes that's true. But scarcity also adds volatility. Colorado's geography and urban planning create structural constraints. Mountains block expansion to the west. Valleys concentrate development into just a few areas, and urban planning limits density. The pace of infrastructure development always lags behind population growth. This creates what I call fragile scarcity. Prices rise very fast in good economic times, but they are also quick to correct downward when demand weakens even slightly because the entire system is already overstressed. The price appreciation in Colorado from 2015 to 2022 wasn't just driven by demand. It was driven by constraints, and markets that are bound by conditions are the most sensitive to interest rates, to insurance costs, and to distressed sellers. Because every new listing comes onto a market that is thin on both sides. Buyers don't have endless options, and sellers don't have endless buyers. The marketplace becomes a narrow bridge instead of a wide-open highway. And narrow bridges are much easier to shake. Small leaks can sink great ships. The risks in Colorado are not dramatic. They are not front-page headlines. They are not bright red warning signs. They are small leaks, a slightly higher insurance premium, a slightly lower migration rate, a slightly more constrained affordability, and a slightly more restricted land use dynamic. But when you add many small leaks together, they are no longer small. That is how fragility works. Not with a bang, but with erosion. And eventually, erosion reaches a tipping point. Despite their vast differences, the 5 states we have analyzed share one common structural problem. They all require perfect conditions to remain stable. But conditions today are no longer perfect. Florida needs a cooperative insurance market. New York needs endless urban demand. Texas needs perpetual growth to offset its rising costs. California always needs new high-end buyers. And Colorado needs to maintain some semblance of affordability. Each of their greatest strengths has now exposed a critical vulnerability. Florida's risk isn't demand, it's insurance. New York's risk isn't prestige, it's the gap between cost and value. Texas's risk isn't migration, it's the velocity of migration. California's risk isn't equity, it's the over-reliance on that equity. And Colorado's risk isn't desirability, it's sustainability. When a strength becomes a weakness, that is when the smart investor pays attention. Do not let urgency push you into a bad deal. Buying a home is an emotional act. It is an aspirational one. It feels like progress because society tells you it is, but the timing of your purchase is critical. You do not get wealthy by buying fast. You get wealthy by buying wisely. I will put it this way. If the house you want to buy will still be there in 2027, make sure your financial foundation will be too. Rushing into a volatile market ever ends well. Patience has never made anyone poor in real estate, but impatience has made millions regretful. So, as you look at these 5 states, Florida, New York, Texas, California, and Colorado, and ask yourself the only question that truly matters. Is this house an investment in safety or an investment in momentum? If it's safety, you will be fine. If it's momentum, you are depending on conditions to remain perfect. And the market is not always perfect. Neither is life. Make the decision your future self will thank you for, not the one you feel pressured to make today.